Texas. Mr. Paul.
I thank the chairman. Today we're talking about reforms in the housing financial markets, which I think is crucial and very, very important. My concern is that there hasn't been a full explanation or an understanding how we got into the mess. And so far what I hear, the little bit we do hear, is that we will deal with problems with more technical solutions and more regulatory solutions rather than looking at the fundamental causes. To me, the fundamental causes are well understood by the Austrian free market economists because they predicted early on exactly what was going to happen, and it did. And they put the blame on three things: fixing interest rates, price fixing, interest rates too low for too long, and also the line of credit that was with the Federal Reserve, which was something the Congress did, even though it was $2 billion. It created a lot of moral hazard because even Greenspan admitted that there was probably about a $14 billion indirect subsidy to Fannie Mae and Freddie Mac, which also encouraged the distortion. And on the books, it was legal, for the Federal Reserve to buy mortgage debt. And of course, there were no restrictions at all because it's done in secret about exactly how much credit will be created. And because of my concerns and understanding of what was happening in July of 2002, I was convinced that, we were working on a financial bubble, and I introduced legislation that would have removed the line of credit from the Treasury, as well as prohibited the Fed from buying mortgage debt, which most people would object to. No, we need them for the emergency. But that's what caused all the moral hazard. And I think it also existed for the benefit of us selling debt overseas. This encouraged foreigners to buy it, knowing the Treasury stands behind this and the Federal Reserve stands behind this, and the whole cycle continues. But when I introduced that legislation back in 2002, I said by transferring the risk of widespread mortgage default, the government increases the likelihood of a painful crash in the housing market. And the system could stave off the day of reckoning by purchasing GSE debt and pumping liquidity into the housing market, but this cannot hold off the inevitable drop in the housing market forever. In fact, postponing the necessary but painful market corrections will only deepen the inevitable. Now, that's not so much my statement coming about that on my own, but because I endorse free markets, I endorse Austrian economics. And I don't see any understanding of that coming from our leadership in the Congress or the Fed or the Treasury. And I think it is so crucial that there is this understanding. So my question is, are you familiar with the explanation of the Austrian economists of the business cycle, how bubbles are formed, and what we should do? And you shake your head yes. If so, if you do understand that, which part of it don't you like? And why don't we look more carefully at those economists? They were right 10 years ago. I believe they're right now. Why aren't they consulted?
Congressman, I agree with much of what you said. And as you and I have talked before in this hearing room before, I think you're right to point out that a long period of low real interest rates around the world played a major role in contributing to this financial crisis, this real estate boom, this credit boom. You're also right that moral hazard played a very important role, most dangerously in Fannie and Freddie. And those institutions were allowed to grow to enormous size, take on enormous risk without capital to support those commitments because of the expectation that government would come in and protect them from the failures. And I completely agree with you, completely agree with you.
My time is running out. I want to see if I can get one answer. My bill that was suggested years ago, would that be a proper thing to do now to make sure that that line of credit and this inevitable purchase of this kind of debt from the Fed, we should restrict that or remove it? Would you agree that that was a good suggestion?
I'd have to go back and look at your bill, but as I said in my statement, I think when you think about what system should replace our current system, a critical part of that is to make sure you don't have institutions with private shareholders taking advantage of a subsidy from the government that leaves the taxpayer exposed to the risk of substantial losses. So I agree, at a centerpiece of future reform will be dealing with the moral hazard in the current framework.
But doesn't the monetary system breed into the system the moral hazard? The Fed is designed to be the lender of last resort.
No, I don't think that was.
I mean, that's what it says. They're to be there to pick up the pieces.
The GSEs were different, as you said, because there was a credit line, and because this expectation built over time that the government would be there. That had nothing to do with the Fed. In fact, the Fed, as many of you probably said earlier.
Our concerns bore out because that's what exactly happened.
Yeah,
you know,
no, exactly. You were again.
The government did pick up the pieces, and now we're in a bigger mess.